Welcome back to the vlog. Thank you for joining. And we're going to jump right into the second half of chapter 2. So, if you were here for the first half of chapter 2, you know that this chapter is titled "The Truth About Trading," and basically, he's going over a lot of the negatives to trading, but they're really just realities to trading. So this chapter comes off just a little bit discouraging, but it's really just meant to give you a true, realistic understanding of what you most likely will experience in the market. And even if not, the negative things that do exist in the market and that can occur. So it's better for you to know and to be aware as opposed to just walking into trading blindly. And if you follow people on YouTube who talk about trading and who do trading, most of them, right? Like, for example, there's Ross from Warrior Trading who goes he's completely transparent. He's gone into the entire history of his trading, how much he's made, how much he's lost, how much he's trading with, so what his trading style is, his techniques, different things like that. And he shows actual proof, like P&L sheets that are verifiable. So most people, I haven't seen anyone else who has actually done that, right? So most people, it's like they're gonna show you the things that grab attention and get views, which are basically when they happen to make money. And a lot of them do not talk about when they lose money, and they certainly are not talking about just the little things, like the little everyday things that go into trading, especially day trading. So that's why it's good to read material like this, which will just give you the straight facts without, trying to bring you in based on just like all this fluff or, 25% of the truth or half of the truth. This is really just giving you like what it really is, talking about commissions, talking about slippage, helping you to understand the difference between like what your disadvantages and advantages are as a retail trader, going in the market up against institutions that have millions and millions of dollars, and just a lot of other things that are on their side. So I can really appreciate this chapter, but try not to be discouraged and just try to look at it as you're being given the truth about the information, instead of like a lopsided view. So, and if you follow through for the whole book, then you should be able to gain like a full, broad understanding, like a comprehensive understanding, of all of the information, and not just some, or not just the bad things. So, all right. With that said, we'll jump back into it. So we ended on commissions, and so then now we'll jump into slippage. All right, so slippage. Most retail day traders do not have immediate access to the trading floor, so their trades are required to move through several intermediaries before being executed. While orders are being routed through third parties, the bid and ask prices of the negotiated security could change. These dynamics are known as slippage, and they can have quite an impact on a day trader's bottom line, especially since day traders place many trades and rely on narrow price movements in order to generate profits. In simple terms, slippage is the difference between the expected entry and exit points and the actual price received. Slippage can have a significant effect on a day trader's bottom line, while the actual impact is less predictable than the fixed and predictable costs associated with commissions and exchange fees. The amount of slippage incurred depends on several factors. Number one, liquidity. The liquidity of a market is the largest predictor of slippage, with illiquid markets experiencing greater variability than liquid markets. Asset class. Slippage varies depending on asset class being traded, since different asset classes have different order execution mechanisms. Number three, order routing. Slippage tends to be greater for orders that are routed through several market makers rather than those placed directly with a single market maker. And number four, order type. Market orders are subject to slippage because they are expected at the best price, whereas limit orders have a hard limit on the execution price. One way to avoid slippage is to use limit and stop orders instead of market orders. However, in such cases, day traders risk missing opportunities. Often they must decide whether the risk of missing a particular trade outweighs the risk of executing the trade at a worse than expected price. In the event that big trades go unexecuted, slippage could lead to fewer gains, greater losses, or significant missed opportunity costs. The most common solution to the slippage problem is to use limit orders when entering a position and stop orders when exiting a position. By placing these types of orders, day traders ensure that they are getting a specified or better price with each trade. There is still the chance that the trade will not be executed, but the risk is mitigated by ensuring that the limit and stop prices are conservatively placed when it is highly desirable to execute a trade. Day traders should also be mindful of slippage when they are creating trading systems. It is important to account for slippage when simulating trades based on historical price data sets, a process known as backtesting. If day traders fail to account for slippage, the predicted returns for trading systems can differ substantially from the actual returns generated. These dynamics are especially relevant for trading systems that rely on high volume strategies like scalping to generate a profit, as the slippage on each trade adds up over time to account for a larger dollar amount. Bid-ask spreads. The difference between the bid and ask price for a given security is known as the bid-ask spread, which largely depends on the security's liquidity, that is, the number of shares bought and sold. In general, securities that are highly liquid have tighter bid-ask spreads, and those that are less liquid have wider bid-ask spreads. The bid-ask spread can vary with time, even when one is looking at the same security. How it varies is based on a number of factors, including times when the stock is volatile due to earnings or new releases. Day traders can compare liquidity between securities by calculating the percent spread. To do this, they would divide the difference between the bid and ask prices by the ask price, then multiply that number by 100. For example, a security with a bid of $3.34 times 200 and an ask of $3.53 times 200 has a bid-ask spread of 19 cents divided by $3.53 times 100, or approximately 5.4%. This figure is much higher than a blue chip stock like Apple Inc., which may have a bid-ask spread of well under 1% most of the time. So for day traders, a lower bid-ask spread percentage is indicative of a better deal, as they would likely be able to buy and sell without incurring immediate losses. Day traders primarily focus their efforts on highly liquid assets such as S&P 500 index futures or blue chip stocks like Apple Inc., for which the bid-ask spread percentage is lower rather than illiquid stocks or other securities. Those who do trade in illiquid securities or in liquid securities that become illiquid could end up losing money from the bid-ask spread. For example, a hot stock may normally have a narrow bid-ask spread, but the same stock after earnings could see its bid-ask spread widen significantly. It is important to consider these dynamics if one wants to avoid getting caught in a tough situation. Professional competition. Day traders face intense competition in the financial markets. Each day, billions of dollars are traded across numerous stock exchanges by a combination of institutional investors, institutional traders, retail investors, and retail traders. While these various groups are all competing to generate above-market returns, retail day traders have the most demanding requirements of all in terms of required returns. After all, making money in the market is not that difficult. It is beating the market that is more challenging. Professional day traders working for hedge funds or other institutions are better trained, better capitalized, and have access to more information than the majority of retail day traders. These factors give professional day traders in the market an immediate edge over retail traders. By trading with their clients' capital, they do not have the same emotional connection to that money, but are still incentivized to perform. These incentives include the possibility of earning 2% of assets under management, or, in the case of hedge funds, getting bonuses amounting up to 20% of profits made during the year. For the most part, professional competition comes in two forms: proprietary trading firms and algorithmic trading firms. Proprietary trading firms are institutions that provide capital to professional day traders or prop traders in exchange for a cut of their profits. Some successful professional day traders begin working at a prop trading firm using their capital before even truly transitioning to paying the firm a reduced commission, trading their own capital in the market with a high amount of leverage to improve their profitability. Algorithmic trading firms, also known as algo traders, prefer to use computer programs developed by quantitative traders or quants to trade on their behalf. Doing so removes all human emotion from the equation and dramatically improves execution times. High-frequency trading operations use similar computer programs to execute thousands of trades per millisecond, so as to take advantage of any opportunity in sight. In fact, these programs often end up canceling about 90% of open orders and executing only on 10% of opportunities, which, according to data from the SEC, are the best of the best. The professional competition in the market is constantly on the rise as technology becomes cheaper and people become smarter. At the same time, many hedge funds have hired some extremely smart people like physicists and mathematicians in an attempt to find even the slightest edge that they can exploit for profit. With lockup periods for client funds and greater access to capital resources, professional competitors may also be better equipped than retail traders to weather the market's turbulence. The emergence of neural networks, genetic algorithms, and other forms of artificial intelligence software could make competing in markets even more difficult in the future. By analyzing millions of real-time transactions, these systems can quickly identify price patterns and trends that would be impossible for any individual to see. The proliferation of these systems on a wider scale in the future could have a tremendous impact on the profitability of retail day traders within the market as researchers continue to explore different possibilities offered by technology. Many experts believe that these trends will force retail day traders to either take bigger risks or increasingly rely on luck in order to generate above-market returns. Managing expectations. It is hard to know what to expect when getting started on day trading with a combination of success stories and dire warnings from financial professionals. Before getting started, it is important for would-be day traders to have the right expectations about how much money they could possibly make and a good understanding of the risks involved in one of the most competitive industries. Realistic goals. Many people think day trading will make them rich overnight. After all, trades that make 5% off of $100 and generate $5 in profit could theoretically make 5% on $10,000 and generate $500 in profits. Becoming rich is simply a matter of borrowing more money on margin in order to commit to day trading, right? Unfortunately, there's many holes in that theory that make such returns unrealistic for day traders. For example, suppose that a day trader with an account valued at $100,000 has a 50% chance of making a 5% return. With a $100 trade generating $5 in profit, he is assuming a relatively small amount of risk in the event that the trade does not turn out, since he would lose less than $100 in total. By placing a $10,000 trade in order to make $500, he would also be putting 10% of his entire account at risk, and could lose up to $10,000 in absolute terms. Although the percentages are the same, retail day traders are concerned about absolutes as well, especially when they consider the emotional impact of losing $100 versus $10,000. When trading as a business, it is important for day traders to set realistic goals and make sure their plans are viable. These goals and expectations are often based off of the amount of starting capital a day trader has and how much risk he is willing to take. Those who start with a large amount of capital willing to take higher risks stand to make greater amounts of money than those who start with low amounts of capital willing to take lower risks. Of course, many retail day traders find themselves on the risk-averse end of the spectrum. What would be a realistic goal for day traders? Most professional day traders target a 20% to 30% return each year, although novice retail day traders may struggle to reach those levels. While returns should exceed the market's 8% per annum average to justify the effort, novice day traders may only break even in the first year or two as they learn the ropes and refine their strategy. It is also important to realize that 20% of $25,000 is only $5,000 per year, which is not an adequate full-time income for most people. In order to generate $50,000 per year at those levels, a day trader would need $250,000 in capital, an amount in capital that is not always feasible for novice day traders to have or advisable for them to risk. Just because professional day traders target 20 to 30% per year does not mean that they are successful every year. Day trading returns often depend on the right market conditions for success. Volatility, or the range of price movement over a period of time, plays one of the biggest roles in day trading returns. Exceptionally volatile market conditions, like those of the 2008 financial crisis, create many lucrative opportunities for day traders. During quieter, less volatile times, it can be much more difficult to beat the market's returns by trying to buy and sell at opportune times. Retail day traders should be prepared to handle the swings that come with day trading and weather the droughts when few opportunities present themselves. The last key point to keep in mind when setting expectations is that the amount of return generated often correlates to the amount of risk taken. For instance, it is certainly possible to generate an annual return of 50% rather than 10%, but it would involve taking on a significantly greater risk by borrowing money and buying on margin. A better metric to measure performance is risk-adjusted return, which accounts for many of these increased risks. As we mentioned earlier in this book, retail day traders are being forced to take on increasing levels of risk in order to generate the kinds of returns they would need to succeed. During periods of low volatility, day traders may be forced to increase their leverage in order to capitalize on smaller opportunities and maintain their performance. This leverage adds risk to a day trader's portfolio and could decrease risk-adjusted returns during quiet times. Most will lose. The majority of retail day traders will be unsuccessful in beating the market's average returns according to the results of a number of different studies showing that returns decline in a trading account as the number of trades increase. In addition to overall underperformance, those just getting started in day trading face a steep learning curve that usually equates to losses during the first year or two, while they familiarize themselves with the market. The combination of these factors suggests that those new to the market will almost certainly lose money, at least until they gain enough experience, and the majority will continue to lose money afterwards. To go back to the poker analogy made at the beginning of the book, the percentage of professional poker players out of all who play poker is extremely low. People who want to become professionals must deal with not only professional competition, but also with a game that is stacked against them in the first place by the casino's rake. While it is naive to say that there are no professional poker players, the argument can be made that many of them experience uneven wins and losses over time, thus skewing their ability to remain profitable. Of course, the findings from day trading studies are skewed because on experience and education, where those with least experience tend to lose more than those with most experience. There are many examples of successful day traders in many different markets, and there is no doubt that the human brain is smarter than any current computer algorithm when deciphering complex systems. The key point to realize is that the most successful day traders are usually professionals with extensive education, experience, and resources. Minimum bankroll. Securities regulators mandate that pattern day traders start with and maintain at least $25,000 in capital at any given time in order to remain in compliance. This rule does not exist in crypto. In addition to the capital requirements, pattern day traders must also trade only in margin accounts. Regulators believe that these requirements will keep amateur day traders from introducing significant default risk into the market by trading in smaller leveraged brokerage accounts. FINRA rules define a pattern day trader as someone who executes 4 or more day trades within 5 business days, provided that the number of day trades represents more than 6% of the trader's total trades in the margin account for that same 5 business day period. In addition to those rules, FINRA provides broker dealers with the right to designate pattern day traders using their own criteria that may be even stricter than FINRA's rules. Day traders can contact their brokers to learn more about this pattern day trader classifications. If a day trader falls below that level, a minimum equity call will be issued, and the trader will either have to commit new capital to bring the account back up to the $25,000 level or be forced to hold positions for a 90-day period to be reclassified as a non-pattern day trader. One big or many small. Many day traders and investors talk of their big wins in the market. For example, Warren Buffett began purchasing Coca-Cola stock back in 1988 and has since made over 1,700% in capital gains on the stock, on top of its steadily rising dividend payments. These stories may be impressive for value and growth investors, but day traders are focused on much smaller gains that they accrue over a short period of time instead of larger gains over a long period of time. A day trader might buy $10,000 worth of a stock at the beginning of the day and sell the position for $10,000 $170 at the end of the day, netting $150 profit after paying $20 in commission on slippage. While $150 may not seem like a lot of money, it is a 1.5% return made in a single day, and would translate to an annualized return for more than over 70%. These types of returns would significantly surpass Mr. Buffett's 18% annual returns in his portfolio. Profit goals per trade. Most day traders will not be able to make a consistent 1.5% return every day just from their trading. If they could, they would be more successful than the world's greatest investor. In fact, most day traders will not even be able to stick to a specific percentage or dollar amount profit over a period of time. The problem with these specific targets is that they incentivize traders to take unnecessary risks in order to reach an arbitrary point for the day, after which, instead of continuing to look for opportunities, the traders allow themselves to rest on their laurels. In reality, many successful day traders abandon these specific profit goals. Instead, they focus on effectively executing their strategy to generate income over the long term. This process over profit mentality allows traders to focus more on overall efficacy of their strategy rather than its performance over a single day. Instead of worrying about daily performance, time can be spent backtesting and strategy and honing its performance over time. Remaining calm. Day trading is widely considered to be one of the most stressful jobs in the world. Unlike a traditional 9-to-5 job, day traders are risking their entire fortune each day in order to grind out small profit, and an entire week's worth of gains can be wiped out in just seconds. A large part of the stress involved in trading is attributed to its inherent uncertainty. Also, decisions need to be made in seconds, not minutes or hours. Remaining calm under these stressful conditions can be difficult, extremely difficult, even for traders with nerves of steel. The most successful day traders are characterized by virtues like calmness, patience, and decisiveness. On some days, day traders will have very few trading opportunities and will need to wait on the sidelines. Other days, they will need to choose between many different opportunities and exercise calmness and decisiveness. The key to successfully acting on these opportunities is to have a plan beforehand. A sudden gap lower after an earnings announcement can be an unexpected setback for a day trader. The novice trader's immediate reaction may be to quickly liquidate the entire position in order to stop the losses, but an experienced trader may instead have a rule in place that requires him to sell half the position and wait for a turnaround before selling the rest. As a result, the experienced trader may catch a rebound to recoup some of his losses. Myth busting. The popularity of day trading as a get-rich-quick scheme in the 1990s has led to a number of myths being perpetuated throughout society. There's a secret to success. I think we'll stop right there. So we'll stop right there, and then we will do a part 3 to this chapter the next time. So we'll just go ahead and end it right there. Thank you for joining again. Don't be discouraged. Just understand that these are the realities of trading. And you just want to equip yourself with the understanding and the knowledge before you go into the market and blindly trade, as formally stated. So anyway, I will see you guys next time. Thank you for joining. See you next time.